Welcome guys, welcome to another episode of Funds की बात ICICIdirect के साथ. Today we have Mr. Prateek Agrawal. He is the Executive Director at Motilal Oswal AMC, a person who has more than 28 years of experience. Prateek is an engineer from NIT Rourkela and has done his MBA in finance. It's an absolute pleasure to host you, sir. Welcome to our show.
Thank you.
So, sir, before we move into our discussion on equities and everything, we would want to know about your journey. And an engineer coming into finance field, आजकल इंडिया में वो चलता है. So, what drove you to the finance world and how has been the journey? So, आप थोड़ा उसके बारे में बता सकते हैं?
No, so I come from a steel township.
Yeah.
Okay, where all of my friends, children basically became either an engineer or a doctor. So, of my batch of 104 students in the school, we had 70 engineers, 20 doctors. And some of the others also became MBAs. So this is how a steel town is. It so happened my dad was an MBA, so he knew that this thing adds value. So, well, he did help me go or find this place out, because in 90s MBA was not the in thing.
Right.
So I would say that definitely helped me discover this space. And once you are in college, how did you choose finance? Well, to be honest, there are extroverts, there are introverts. Extroverts take sales and marketing, introverts take finance. That's right. How it happens. Yeah. Simple. No, and more this thing, you come with engineering background, some numbers you are able to crunch. Finance has numbers you are able to crunch, so that's an advantage you have. But major thing is extroverts take marketing and sales, introverts do finance.
Absolutely. So being an introvert, you chose finance, I can say. But you don't look like one. Okay. Yeah. So, sir, moving ahead today, let's talk about the markets. Market is at all-time high, in the all-time high territory, 19,400-ish level. And there are a lot of questions people have, should we invest at this level? And a lot of people who like to sit on the fence, whether awaiting the correction. A lot of people waited for the correction in 2020 when we had the COVID fall. And every time they wait, when there's a correction, they wait for a correction, but they do not enter the market. So what is your take on this? How should one plan his investment at this level in the market?
No, everyone to himself, because in the market you are taking risks. So you don't take risks based somebody else telling you. But let us look at, one, you are in India. India is a growing market. There is no economy which is supposed to be growing so steadily for so long, deep into the future. That gives you tailwind. Okay, this is a market which is very tightly regulated,
right? And
increasingly, if you see the quality of companies which are coming into the market doing well, I think very different from what was there, let's say in 90s, in early 2000s and so on. So the character of the business in the market has changed dramatically. So in that manner, secure. Third, this is a market where information is now very widely available, and hence democratized. So there is no one entity who has an edge over the other. If you look at the market, while markets may be close to a high, valuations are not.
Right.
So last high in the market was made, let's say, now close to a year back, 10 months back. Okay. Now 10 months back, if you're looking at quarter 1 results, we see actually see more than 20% earnings growth. Now, which means valuations have corrected by that much, So markets close to a high, not valuations. The other thing is where are valuations in terms of averages, because you're not looking at peak valuation,
right.
You're looking at average valuation. So my construct I can share. My construct on valuations is 18 to 18.5 times 1 year forward, and this is the range you get if you look at valuations from 2012 to now.
Yeah.
Okay, people who say markets are expensive, just to make it clear, look at valuations from 2002 till now. And if you remember, 2002 to 2007, you had a huge scale up in valuations. Now, why I take from 2012 till now is because the composition of the index changed dramatically between 2002 till 2008. Earlier it was a commodity heavy index. It then became more heavy on higher PE businesses.
Yeah.
Is the case. So 18 and a half is my construct. If you look at 2025 earnings, you will get a range from 1075 to 1100 plus a bit. So take a ballpark 1100, multiply with 18 and a half times or the top end of the sustainable numbers. It can go higher and you get 20,300. Now, where we are 4-5% away from that number. Now, this is lower than debt, which is what you are competing against, right, when you are allocating assets. So, and hence I say expect a quarter of consolidation. You may go down, you may come up, you may go up, you may come down, but a quarter of consolidation results in a valuation correction of 4%, because earnings compound at 15-16%. With the other 4 that you have, you have a 8% kind of return expectation to fair value over a period of time. Now, if you're competing with debt for an HNI category is 5%. 8% less 43% is what he is left with. You gross it up for equity tax, you get 5.75 even if you do short term, and then you add 2% equity risk premium, 7.75. So if you get a 8% kind of this thing, I think the decision to invest into equity happens, and that a quarter of consolidation gives you. So, and that's my logic for saying that don't expect a largish correction. This is a country where, while we are getting in many number of people as investors, and we will talk of that separately, but even the chunky money today is becoming investors. They're no longer savers because savings don't yield much. So that becomes the hurdle. And then you do earnings growth kind of compounding. So that is the whole thesis.
So basically, we can say that the price-wise, Nifty may look expensive, but valuation-wise, we are not that expensive, and we can expect more run from here after a quarter of consolidation. So basically, post quarter 2 or quarter 3 results, we can go ahead with, we may expect more run in the market from there.
Don't look at it quarter to quarter, because see, if you look at any manager, any person who is talking will at least talk 1 year hence earnings, if not 2 year hence. So thing is, in India, look at multi-year earnings growth. So that is your tailwind. This is the only economy in the world who is doing growth in a very measured manner, so that it sustains for very long. I made this point of EPS expanding from 100 to 125 to 150. The longer it continues, the longer the compounding continues. Now, suppose you do all of that growth in one fine year, 100 to 200, and then you stagnate. Just think about how the stock will behave.
Exactly.
Is the difference. So quantum of growth sustaining for a very long period is the magic. And I think as a country, I don't know how it happens, but we somehow have found that very nice spot. The other tailwind that we have for us is, one is economic growth. The other is that we are still significantly away from the high point of margins, which happened in 2007. So we are improving. In between, you got a commodity bump up, we fell. But now, hopefully, as we go forward, you again. So this year is all about margin increase. So that is the other tailwind we have. Slowly, surely, it will contribute as you go forward over the next 3 to 4 year kind of a block.
Absolutely. So bottom line I'll take from here is that market may look expensive price-wise, but valuation-wise we are cheap. So you can invest at this level in a very sustainable manner by doing SIP. So next question to me, like you're talking about valuations. There's this one sector that we have seen has seen a lot of beating since the first year of calendar year of 2020 Jan 2022. That is the IT sector, and a lot has been spoken about the new advent, like the Chat GPT thing coming in, the AI thing coming up. So what is your take on this sector particularly, and then we move on to the other sectors?
Yeah. No, so anything new happens, it is good news
Yeah.
because then a lot of things have to be done, and Indians will do that. So over time, it will result in a lot of business for our companies, is what we understand. It is just that today, people may be a tad wary about spending because of the global environment that everybody keeps talking about. But if everybody knows about AI,
Yeah.
be sure a lot of board members will be asking the CEO, how are we prepared for AI disruption?
Right.
Are we doing enough? As soon as they start to ask, spending start to happen, we should hope for a good, nice pump up over the next few years. But that probably starts to happen as the year changes and budgets get rolled out, and hopefully by then, you see the peaking of interest rates and sentiments getting more normalized rather than today's belief that we have to see a slowdown before we go
Right.
up again.
Right. So do you see value coming here? And if someone wants to invest in the IT sector, is it a good time?
So
Yeah.
you have to look at the construct.
Yeah.
Every share price is fine because there is a seller, there is a buyer,
Yeah.
right? What are you trying to get? And I've said there are two ways of investing. Either you are a value investor or you are a high quality growth investor.
Yeah.
Now I say high quality and growth together because if you are only looking for growth, it can be cancerous growth and you won't make money.
Yeah.
You will get slaughtered. So high quality, high growth investor or value investor.
Yeah.
Now, IT in most spaces, mid cap IT may be different, new tech is different,
Yeah.
but otherwise in most spaces should be expected to give earnings growth lower than that of the index.
Okay.
Okay,
Yeah.
so you go there if you believe it is deep discount, and you get a bump up.
Yeah.
Now most commentators will tell you that it is fair valuation. So you should make fair returns, not excess returns.
Right.
Fair means close to index plus minus something kind of return.
Yeah.
So that is where large IT is.
Absolutely.
Is according to me. So one has to, because I don't see, people may say that there is skepticism because of a global slowdown.
Yeah.
So I said, no, find a reason. This may be the reason. If it changes to euphoria, you may get a better return. So
index plus minus in that 2% range.
matlab is my thing. I am a high quality, high growth investor.
Yeah.
So, but I was just saying, in this space, if you believe that today the valuations are very depressed because people believe there will be global slowdown, etc., and it turns out to be opposite, and you believe it should turn out to be opposite, you can end up making sizably more than index kind of number. If you ask me, I believe chances of that is lower.
Okay.
Basis the fact that there was a particular run rate at which our IT was growing before the COVID thing. Now after that, we are again getting there.
Yeah.
And if we are again getting there, then our valuations are similar to where, actually even higher than where we were pre-COVID.
Okay.
So unless we see evidence of AI-led investing, ordering move up significantly, I think we should expect this pace. And this is a personal view. My own managers, one or two, may have a very different view. We should expect numbers closer to index or lower is my sense on the large cap IT. Mid cap, some spaces have tailwind, so that's a different space.
Okay. So sir, from IT, I'll come to your sector. That what sector are you bullish on, and where do you find growth and high value and high quality growth?
Since you are talking IT services, I think new tech, where especially you are moving from a loss to a profit, is a space that we are very clued on. I think retail lending is something that we like.
Hmm.
Done in a digital manner, we like more. We like services that seniors will end up using,
Okay.
because this is a space which will see a higher growth versus any other age cohort, plus 60 age cohort. So
Okay.
services that those guys will want should see very strong tailwinds. We like in consumption luxury.
Okay.
So that's a small space in India, but now some of the companies are getting sizable. These are the brands one would remember when India probably increases per capita to twice as much,
Yeah.
and have a very long runway of growth. We like spaces where growth can be very fast in terms of manufacturing. So, engineering companies have very high operating leverage, are very fixed cost intensive companies. EMS companies, and one good way of playing the manufacturing NASA is to, or the capex thing is to look at, let's say, cable companies which go everywhere.
Right.
So people say cement. We would believe cables are probably a better way of doing what a cement used to do to a portfolio in the past. In autos, electric autos, and the way to look at it is don't bet on companies which made a huge success in ICE. Look at companies which did not do very well in ICE but have a very good engineering capability. And I think a disruption like EV gives them a second chance. Every disruption gives chance to a new guy.
Absolutely.
So that is the manner of seeing the market. China plus one is a big one. So garmenting companies, chemical companies is something that we are clued on. So these are the
few baskets.
big themes. So each one of those defined very narrowly, so that as a house we move in one direction. Yes.
Okay. So sir, you have a plethora of funds and seen like the themes that you have given us. So if somebody wants to invest via mutual funds, and because you cannot invest into all companies individually, so people take the mutual fund route.
Yeah.
So any fund that particularly, any fund that one who's listening to us can prefer on the play on the themes that you have just mentioned. So you can just tell us about that, would be better.
While we encourage all managers to represent all themes, one very simple way of looking at it is, most of the themes that we spoke about lie more in the mid-cap space, and that fund hence ends up representing them very well. If you look at the market space also, and we spoke of it, the mid-cap space has done better. And we do believe going forward this is a space which can continue to do better, because all the themes that we spoke of lie in this space. And if we look at valuations on a cap basis, while mids are a tad higher than the large cap index on an average, but still very, very sustainable levels.
Okay.
So I think till the themes that we spoke of continue, and there are many more, we have ethanol policy and so on, a lot of small defense, till they continue, I think this is a space to be in.
So basically the mid-cap space we can just focus on, and I think you would have a mid-cap index fund or something, mid-cap fund or something that.
So we have both index funds and an actively managed mid-cap fund.
Absolutely. So viewers who are listening to us can view these funds at Motilal Oswal's website, also on ICICIdirect website, and also you can look at our one-click basket where we give a detailed analysis about these funds. All right. So moving on to my next question. So sir, I'll stick to this part where we are at all-time high. You're given the answer. Now, one more big event that is approaching is the elections. And we have 3 state elections, big states, coming up, and also a run up to the general election, which comes in the first half of 2024. And we have seen that whenever a big election, a big event is approaching, there's a volatility witnessed in the market. So, do you expect volatility to continue? Like, expect the volatility in the run up to these elections?
Yeah, so equity markets should be volatile. Equity markets are volatile. To expect anything else is wrong. Reasons can be different. So it can be elections, it can be interest rate moves globally, it can be currency moves globally, it can be किसी भी leader को छींक आ जाए. So reasons can be anything. Now you have to make use of we are not bothered about positive volatility, that we will accept very, very happily.
Yeah.
More bothered about negative volatility. If we are fully invested, we should be invested into spaces where we believe it comes back and very quickly. Else we should do asset allocation and have something to invest if we get a negative volatility. That's the rule.
Yeah.
Now, how we look at a particular event that you are saying and the others that I spoke about is a risk. Okay,
Yeah.
how do you mitigate that? One, you mitigate that by focusing on quality.
Yeah.
Quality means if the business is supposed to grow at a particular rate, what brings volatility is debt.
Yeah.
There is a business setback, the impact on earnings is much more. So the more volatile the earning is, the more volatile the stock price would be. So by reversal, if debt is less, the stability of earnings is higher. So quality has to be high.
Absolutely.
That's the start point.
Yeah.
Second, you diversify. You don't go overboard in a single stock. So if you look at our portfolio, they are very flat now.
Yeah.
We are making them flatter, so except for the mid-cap fund where we do have 2-3 names which are heavy.
Okay.
Otherwise, our portfolios are less concentrated in the index itself. Top 10 for our weightage versus top 10 of the index, we are less concentrated.
Right.
While we run, less than 30 stock portfolios. Only house which runs focused high conviction portfolios. So that's the second thing. Third, diversification.
Right.
So all the themes that we spoke of, unless that theme is not there in a space, you should expect it to be there in the fund.
Absolutely.
So any part of the market sees participation, positive participation. On the growth side, we should see something in the portfolio do well. And now, if you see the portfolios, so let's say even a mid-cap fund. Mid-cap fund, 65% has to be in mid-cap. Rest of it can be elsewhere.
Yeah.
We have tried to cover the market cap spectrum. So forth also for our LMC and focused and so on. Trying to have representation, any part of the market works in terms of market cap, there should be participation. So unless high quality, high growth as an investing style goes out of fashion for some reason, and maybe value comes to the fore, we think we have really put our best foot forward. Something in our construct should perform, and our investors should be taken care of.
Absolutely.
So
I'll just take it in that way that you have to expect volatility with stock market.
Yeah.
To have to be comfortable with that volatility, have diversification. Diversification is the one mantra that one should always follow. And being diversified makes you digest that volatility in a positive way when there is a negative volatility.
Yeah.
And that's how.
Look at it, if we are high quality, high growth, I keep saying this, if the growth continues and you get a negative volatility, it's a great time to invest.
Exactly.
Because earnings growth has happened, time correction has happened. If you believe in this philosophy of high quality, high growth, and you see us following it to the T, great time to invest more.
Absolutely. Can I also take this from you that one should also have some dry powder right now? If we see a negative volatility in the run up to this event, one can enter the market that time. And
so I think I digressed in the last question. So the other thing is, when you construct the portfolio, you don't want too much of businesses which are which may be impacted more if something happens on on a particular
Yeah.
event. So what we do is to share with the managers how are the portfolios looking for a particular event.
Right.
You know, interest rates moving up, currency depreciating, COVID kind of a situation happening. What part of the portfolio is very, very driven by, let's say, policy. You know, what a portfolio does for you is one part benefits, one part doesn't.
Right.
As a portfolio, you should not be having to change much.
Right.
You know, so that is something that we have built in the portfolio construct itself.
Right.
So that is the way to address risk. We any which way stay away from businesses if you are talking of this risk, which are seen to be close to government kind of
Got it.
businesses.
Yeah.
We tend to be away. You know, if QGLP is our philosophy, quality is the first start point. You know, low on debt businesses, cash on book businesses is the start point. So
So it
that
doesn't
looks
matter with
taken care of.
whatever event is in future. That's right. So you're talking about diversification. So my next question, which comes to diversification, we've spoken about equity. Let's come to the debt side, fixed income side, and a lot of fund managers, like in 2022, the last half of 2022, preferred debt as, like they said that debt will do well in 2023. What is your take here? And suppose somebody wants to invest here, what I know it cannot be one fit all size thing, but if someone wants to invest, what percentage of his money should be allocated to a debt instrument and how much should be in the equity instrument?
Many ways to answer that. Asset allocation has to be done, should be done, so that in the event of a negative volatility, you have some dry powder to make use of that
Yeah.
negative volatility, right? Second, if you need money in a specific period of time, I think you have to plan with debt rather than plan with equity, because equity markets have their moods.
Right.
They may get into a mood beyond your holding period.
Nice.
So people often ask, what is a long term? You know, and the answer is 3 to 5 years. Well, it can be longer.
Yeah.
You know, 2008 till 2020, the CAGR in the market was very similar to debt, if not lower. So it can be longer.
Yeah.
The thing is, the term of holding is when the market decides to get the mood right. It can happen quickly. It can happen, you know, over several years.
Yeah.
Anything that you need, you know, son's education, medical stuff, whatever, you know, that again as a part of asset allocation should be planned more with debt is my sense. And yes, as your risk appetite reduces, as you get more senior, I think the percentage of debt in the portfolio should increase. It can also happen in equity as to what kind of equity you build more in the portfolio.
Right.
You know, so we say we want to provide preservation and growth, and we put a huge lot of risk control into what we do. But then, yeah, beyond a particular this thing, one has to be or should be more in debt versus equity. Now, this is one way of looking,
absolutely.
And a more traditional way. I would believe a very large part of the investors this is what they should be doing. But you know, it changes. If you have a business, for example, okay, which is giving you cash flows period after period.
Yeah.
Now, if I speak to wealth managers, they tend to think of that as equity.
Right.
Okay. But to me, it is debt.
Right.
Because what a debt is supposed to do for you is to give you money every period.
Absolutely.
Now, you have a great business. It is giving you money every period. Yeah. Should be looked as your debt allocation rather than equity allocation. If you have that, then a much larger part of your overall could be in equity than otherwise.
Absolutely. So it again comes to individual, but the story is that if you want some short-term money, that should definitely go into debt, and you want to play the long-term story, that goes into equity, and based on your risk profile, one should invest accordingly. So moving on, We spoke about buying, we spoke about what sector to focus on, what sector not to focus on. A very important factor in this market is when to sell, because people do not know when to sell, because people are too attached to an equity or too attached to a stock or a fund, and they do not end up selling, and we see the price going down. So as a fund manager and someone who's managing from past 28 years, when do you decide to sell, and when do you decide कि अब इसका time हो गया, it's time to book profits and move out?
What we have tried to do, so when we do high quality, high growth investing, most of those businesses can be valued on a DCF framework.
Right.
Now, what a DCF framework then does for us is to give you implied growth, implied return kind of matrices.
Right.
Now, on a DCF, if something looks expensive, so what does a DCF do? DCF, you think you need a required rate of return, let's say it is 12%, you will put future earnings,
Yep.
you will discount it by 12%.
Yeah.
Now, on that, if the stock price is, let's say, 100, the number that may come may be 90.
Yeah.
So, by that measure, it is expensive.
Right.
Okay. But in equities, in this equation, expensive does not mean negative returns.
Right.
So, suppose instead of 12% discount rate, you take a 11% discount rate, it may match
Yeah.
or go over.
Yeah.
So, and then you get, so what you tell yourself is, I wanted 12%, but at this level, this stock is going to give me, according to my projections, 11%.
Right.
Right? And then we compete
Right.
versus the other choices that we have in the marketplace. If there are others which give you a meaningfully different outcome,
Yeah.
I think if everything looks good, we want to be there. Otherwise, this is the best that the market offers and we stay put.
Right.
So this is how it is.
Absolutely.
It has never happened that, so the delta valuation, the price delta
Yeah.
that you get for every percentage cut in your required rate of return is pretty large.
Right.
So you put an 8% kind of numbers, practically
yes,
everything will seem to be
investable.
right?
Yeah.
So this is what we end up doing. And at the same time, as a part of risk, what we have said is we want flatter portfolios.
Right.
When a flatter portfolio, something does very well, it increases in weight.
Yeah.
And then what we say is take some money off the table. Automatically in a portfolio construct, if something has gone up, something has to go down.
Yeah.
That has underperformed.
Right.
If you are still positive that space, farm some money back there.
Right.
So in some manner you're booking profits,
And
farming
harvesting,
it into
yeah.
something which hasn't done well, trying to capture some discount to value.
Absolutely.
So that is something, these are the two things that we end up doing.
Absolutely.
Otherwise, there are not too many businesses which can keep compounding for
Yeah.
a very long period of time. If you find one, you stick with one.
Right. So basically, I'll say that cyclicals one, like you book profits regularly because there is a cycle for every.
We tend to stay away from deep cyclicals.
Okay.
Or enter early in a cycle and stay put till the cycle continues. So,
Right.
for example, today we are in engineering. Engineering can be deep cyclical, but
Yeah.
today, if you are saying that manufacturing as a percentage of GDP has to climb by 6-7%, we are still at a very early stage of
Yes.
that. Maybe we have few years to go. We want to be there, but we are not into deep cyclicals like commodities.
And, yeah.
So that is how it is.
Absolutely. And viewers wondering what is DCF? DCF is discounted cash flow. It is a way to value company. So in a way, if you want to learn, like read about it, you can Google DCF. There are many books on it and many terms associated with it, like WACC, cost of equity, cost of debt, everything. So you can look at, because what Sir has explained is in a very, in 2 minutes he's given us a brief, but it is a very deep topic. If you're interested in finance, you can definitely look at it. So sir, these were my main questions covering the equity side, debt side, when do you sell, when do you buy. So there is, since 2020, I look at it as two periods. When pre-2020 was different, post-2020 was different. Number of investors have also increased. Number of the ticket size for mutual funds have also increased post 2020, as you've seen. But there's an advent of new thing that is called as futures and options, and everybody wants to get rich quicker. And post 2020, we have seen a lot of people moving towards the derivative sides. And you've been in the market. You have been in the market when the this instrument was launched. So what is your take and what is your message to people who are who heavily do derivative FNOs? Is this a wealth destroyer or a wealth maker according to you?
No, so I think the data that gets shared from time to time shows that there are very few people who make money.
Right.
And if over 1 year some 6-7% people end up making money, actually 6-7%, yeah, people end up making money. The same people may not be making money the next year.
Absolutely.
So get rich quick happens, but rarest of rare instances. Mostly I think investing with a plan is what has much better outcomes for most people.
Right.
So I would say don't do it. But at the same time, this is a skill which probably our generation just got introduced to. The next generation is starting with it.
Right.
This is a skill which in the West hedge funds increasingly deploy, and I think as we go forward, even in this country, we in our generation are blessed to have a very strongly growing economy, and even without leverage,
Yes.
long only equity fund can deliver substantial returns. In the West, when growth is 1, 2, 3, at best 4%, you need leverage to have good returns, and where all of these skills come in handy. So I don't know. We believe India has a very, very long runway of growth, but once our growth slows down, I think all of these skills will become that much more valuable. So good to learn, but don't go overboard. Do it with a very small slice of your money. Do it more to learn rather than get rich quick. Get rich quick once you turn 50, you find has not happened to most people.
Absolutely.
What you see is a billion people trying, only 1 or 2 successful people getting shown to you.
Yes.
So learn and then.
I think I can take one line from what you have said, that if you want to play the India story, I think it can be played through equity markets, because we expect our country's economy to grow, and that's how we can, rather than getting into futures or option, you can, as a veteran, Mr. Ramdev Agrawal says, buy right, sit tight. I think if you want to play the India story, do it through equity, not via futures and options.
Preferably through mutual funds. But yeah, I mean, for youngsters, for people, I think markets are a much better place now versus, let's say, 90s and early 2000s.
Yep.
Seen a lot of changes for the better,
Right.
way more safer. The other way to look at it is we are starting on an, what happened in the US in the 70s, the 301k kind of plans, where structurally money comes into the market. We are beginning to see that in India, where month after month you are seeing mutual funds get money, providing a much higher level of stability to the markets. Not only mutual funds, insurance, it is pension money which is coming in. So you have tailwinds, and I think there is a learning everybody should do. But I think there is also a role which professional fund managers provide. So, I keep saying this, the bulk of the money you want safe, and hence in a debt asset class, most of the money is in liquid.
Yeah.
As you go higher up on returns, the amount of money, let's say, that is being put to work is smaller and smaller. For something like, let's say, high yield lending, high yield products, the amount of money that you will put is a very small amount. Same way on the equity side, I think bulk of the money should be with managers. I would suggest that you slot managers into best exponents of high quality, high growth, and best exponent of value. Decide which space will do better, and asset allocate first on these styles, and then some bit of money one should definitely try their own hand on.
Yeah.
Now, here again, one can increase the chances of success by being into their spheres of competence. So, if somebody is, let's say, working in an engineering kind of an ecosystem, he would know much more of that by virtue of the ecosystem itself. Much better chances of success there. Be it cement, be it engineering, and so on. Stick to there. For other spaces, I think professional managers are much better equipped.
Yeah, I think that's very important because people who understand their game, their money should be trusted with them rather than you not knowing your game. Sir, we have spoken everything about market. Whatever I could have taken from you. But I wanted to know, what do you do when you're not tracking the markets and someone who's not around the marketing, like the finance market world? You like to read, or you like to go on trips, or what is your hobby outside market?
No. So trips are good. That's a good way to burst the stress. I also like to play games, work out and so on. So that is how it is. I think the job itself requires you to read hell of a lot. So not a great reader of books. So I did that when I was younger, no longer. If you have noted, I have quoted nobody. Okay. So because in the marketplace, I believe everything has been said. So for every quote, somebody else who is that big would have said something else. Okay.
And then very Buffett, Warren Buffett got already.
So वो फायदा नहीं है. It's a manner of trying to get credibility into what you are saying.
Right.
And whatever you read has happened in the past in a different market, different context. Very little of it can be applied in the present. So I want to look at the market. The market talks to me. I talk to the market. Why something is happening? Why something not?
Right.
That helps me create themes. That is how my mind works.
So, absolutely. So books, you are more into you're not into books. Market news and all is
very less on news as well. More onto what is happening. Why you thought this should happen, not happening. If it is happening, very good. So this is working. So just to give you an example, last quarter, not this quarter, the one before, you got a result of a PSU bank, and the paper screamed all-time high profits, way better than expected, and stock did nothing.
Yes.
Okay, and then another one happened. Stock did nothing.
Yes.
Okay, so does it tell you something? Why did it not happen? It is better than expectation. Everybody is screaming better than expectation. Everybody is writing about it. Okay, but the stock has not happened. So why?
It's already priced in.
Why? So that is how the market speaks to you. You want to find out, and then if you have found out, it's a thesis. You then see whether it's changed. So what we said is, maybe the base effect is moving out. Maybe going forward, it is the AUM growth which results in more sustained outlook rather than profit growth. So very different parameters. Now, if AUM growth, you get a different set of banks, and you develop a theme and you move the portfolio. So that is what interests me.
Right.
This is what I am saying. The market speaks. You speak to the market.
Absolutely.
Try and understand.
Exactly. So it's more of a future look rather than reading the history. Absolutely. So viewers, this was Mr. Prateek Agrawal from Motilal Oswal. It was a pleasure hosting you, sir. Thank you so much for being a part.
Thank you so much.
Please note, mutual fund investments are subject to market risk. Read all scheme related documents carefully.